Okay. Jamison, thanks for chatting with me today. So this podcast is Kiss My Assets, which is a great name. And we're talking a little bit about a couple of different articles today and maybe some kind of tips and tricks that we can take from those. So this first article, give us the lowdown of kind of what all this means and what's happening.
Yeah, so there's a company that's been an apartment syndicator, apartment buyer, and they've been very aggressive in the last 10 to 12 years.
Mm-hmm.
And what we've seen over the past couple of years, obviously interest rates have gone up a lot, and that impacts apartment ownership. It impacts the value of the apartments in the resale market.
Mm-hmm.
And this group was very aggressive on the front end about buying buildings, but now the payments need to be made at higher interest rates. So this group that the article is talking about is Tides,
Mm-hmm.
and
Based in LA.
based in LA, and I believe it's their third building that they've lost in
Yeah.
the Phoenix area
Right.
that went back in foreclosure. So what has happened the last 18 months or so is banks were doing what I call extend and pretend, meaning they would give apartment owners more time on their loans and in some cases keep the interest rates lower than where they should be to see if the market would come back around,
Okay.
see if interest rates would come down a bit. And really beginning in 2025 with the new administration, everything, kind of a transition period. Many lenders now are saying no more extend and pretend.
Mm-hmm.
We either need to get caught up or we're going to take some action on the property.
Gotcha.
And so Tides is kind of the poster child right now because they bought a lot of apartment units in a short amount of time, around 20,000 units in a very short amount of time.
Wow.
And many of those transactions they bought at the peak of the market, and then now as they go and do the valuation of those units, they are upside down on many of them. So the latest one is an example of that.
So why is it significant, or is it significant, that Tides lost this property for more than they originally paid, but it was still a foreclosure?
Yeah, that's not uncommon right now.
Okay.
So we bought 2 buildings in foreclosure this year,
Mm-hmm.
and those were similar situations. The first one, the person had refinanced it around a $17 million, $18 million value, and we ended up buying it for the debt at $13 million because that's where the value is today.
Wow.
And then the second one, which we bought, venture on 52nd Street, they purchased it for $18 million 2 years ago, and we bought it in foreclosure for $11 million. So that's not uncommon today. And
Gotcha.
and if you're a group like Tides and other groups, you really don't have many options because the market is its own beast. You can't fight the market. You can't fight the Fed. You can't fight interest rates. So we're going to see more of these. This is not like 2008 great financial crisis when this was happening to single-family homes.
Mm-hmm.
That was driven by adjustable rate mortgages at the single-family home level.
Yeah.
And that was more in the mainstream because you could drive down your street and you knew your neighbor was losing their house and values were going down, and it was a bit more in the
It was close. You felt like it was happening to people that you knew. Like you said, your neighbors. This is at a little bit of a higher level, maybe, but it's different.
Yeah, and it's more quiet because these are institutional, sophisticated investors who are participating. But there's going to be more of these, and we ourselves have had at Neighborhood Ventures. Any apartment owner has had some difficult times because of what interest rates have done. The other thing is there's been a lot of new supply, new construction, and these projects were planned when interest rates were really low.
Yeah.
And that also has made rents flat for about 2.5 years, flat to slightly down. So it's kind of both of these things have happened at the same time. So there's apartment owners who are struggling. You know, if you're a long-term owner and you have permanent debt financing, you're just operating right now and you paying your bills and you're not selling. you're going to be fine. But if you did some renovations, if you have short-term financing, that's when it gets more challenging.
Gotcha. Let's talk about the people who are living in these buildings, the renters themselves, because when a building like this goes into foreclosure, at least as much as I understand it, is that there's a lot of transition. This is going to a different management company, perhaps. Maybe things won't be taken care of in the same way. Talk about what this means for the people who are actually living there.
Usually there isn't much disruption. To your point, anytime there's a change in ownership, there's likely a change in management. Mm-hmm. And then sometimes the same owner will say, oh, this property's not doing well, I need to put a new manager in. We toured a building this week that we're looking at purchasing, and they've gone through 4 property management companies in 2 years. It's just, and so the renters there's no continuity.
Yeah.
The tenants, we actually like to call them residents instead of renters or tenants, mm-hmm. because it's their home. So the residents, besides kind of who they pay their bill to, who they report maintenance issues to, mm-hmm. there's not a lot of disruption for them, because if a new owner comes in and takes it over, they want that resident to stay in place and keep paying their rent. Mm-hmm. But in the case of like the building we saw today, those residents, they just said, yeah, it's kind of weird. There's been so many management companies in a short amount of time.
So with this article, with the company Tides that lost this building up there in Cave Creek, neither one of these companies, not Tides nor the lending company, MAC, have been able to be reached for any sort of comment. Do you think that says anything to the larger community, that these companies don't want to come out and make any sort of statement?
Yeah, I think it's not uncommon because there's not a lot they can say. In some cases, and coming from a public company, investor relations and public communications background, sometimes the writing's on the wall, and there's not a lot to add. And when you do add, you're kind of giving excuses, and nobody really likes to hear that anyway. So I have heard the Tides founders. They have been on some podcasts and at some conferences. And everyone, it's pretty much known in the industry, some of the challenges that they're experiencing. What they're experiencing is not unique. It's just they are experiencing a lot of it, mm-hmm. because they bought so much at the high part of the market. There's a few companies that were very aggressive on that upside, and they're going to be more front and center. They have communicated. I'm sure they're communicating with their investors. Mm-hmm. If a media company reaches out to them, they have no obligation to talk to them. In some ways, it's probably better they don't, because there's not a lot to add sometimes.
Gotcha. No, that's an interesting point that, the writing's on the wall. This is what it is. And so making sure that your internal situation is taken care of, your investors know, everyone in your company knows, maybe it doesn't need to go past that. That's interesting. Let's talk about the comps from May. This is interesting. I would love to hear your thoughts on these different buildings, on what was sold. Just kind of tell us a little bit about this.
Yeah, so we tracked the multifamily market in Phoenix very closely, because this is where a majority of our assets are, and this is where we also will continue to gain more assets. Mm-hmm. There's something like 500,000 apartment units in the Phoenix metro area.
Wow.
So there's a lot of apartments here in existing apartments. All ranging from Class C, very old apartments, to the brand new, beautiful ones that you see, in Scottsdale and some in Central Phoenix, Tempe, and other growth areas. And in the last 2 years, 2023 and 2024, we added about 20,000 new apartments to that pool, which in those years we were one of either top 1 or 2 in the country for new apartments. Mm-hmm. Dallas, Houston, Austin, those are also big apartment markets.
Cities that are growing.
Cities that are growing, typically in the Sun Belt. And Phoenix has been right up there at the top. And that was what I was referring to a little earlier about all this new supply. Mm-hmm. That tends to bring level the price, in some cases take the price down. And the price in our situation, in our context, is the rent that people pay. So when there's more supply, it keeps rents low. So we've had a lot of additional supply. And then at the same time, if you are an apartment owner, the resale market is almost frozen. There are not many transactions happening. In May, for apartments, buildings with 100 plus units, there were 5 total transactions in the valley. That's very low. If you look back in a normal market, there would be 4 or 5 times that in a month.
Wow.
So we're probably 10 to 15% of the transaction volume, and this is just when apartments are being traded from one owner to another.
And is this mainly because of the supply, like what you were just talking about, or do interest rates play a big part in that?
It's mainly because of interest rates, and if you're an apartment owner and the property is performing and you don't need to liquidate, you don't need to sell, you don't sell right now. The transactions that are happening are almost exclusively groups that need to sell.
What we just saw with these foreclosures.
Foreclosures are a part of it. There's also groups who build these new buildings. Typically, they'll build them, they'll get them leased up, and then their plan is to sell them.
Wow.
So they're to execute their plan, to get their investors paid back, to get their lenders paid back, they do need to sell. Now, new buildings right out of the ground, those are still selling. There's still a lot of demand to buy those buildings, and they're purchased by more institutional buyers. But those are brand new buildings, and a big pension fund or Goldman Sachs or other large equity groups will come in and buy those and say they're going to hold them for a long time, and they're happy to go buy those right now. And those are selling, and you can see in some of these comps. I'll just point out a couple of them. The core Scottsdale. This is Hayden Road, North Scottsdale. This sold for $350 a unit. That's less than they would get in a robust market, but that's still a good clip. And then this one in Chandler, Arden Park, also sold for $350 a unit. That's not bad.
Does location play a big role in this? Because you just said one in Scottsdale and then one in Chandler basically went for the same. Is this more based on what the apartments look like, the level, the class, or does location play any part in that?
Yeah, location is a big part. Let's just look at these two. So the Arden Park property, that was built in 2023, so brand new.
Yeah.
So there's definitely a premium on a new property out of the ground, and they're also bigger units because it sold for $319 a square foot. The one in Scottsdale, both of these areas are nice areas. Scottsdale is a more attractive area, but this one was built in 2017, so still newer. $423 a square foot. So there's that Scottsdale premium from a price per square foot, but then the per unit was about the same. So these are good institutional quality assets. They're 392 units, the Arden Park, and 282 units, the core Scottsdale. And so an institution came in with $100 million and bought Scottsdale, and $140 million bought the other one, and these are going to be great assets for them.
Yeah.
The other one that I'd point out that are kind of different, so that there were 5 trades over 100 units, and 4 trades between 10 to 99 units, which are smaller multifamily. And those ones, the average price per unit of the 100-plus units was $325,000. The average from 10 to 99 units was $164,000. So you're getting better deals on the smaller or medium size. That's the area where there are fewer buyers today. That's the area we buy in. We like 50 to 150 units. So the institutional market that buy these big, beautiful buildings, that's still fairly robust. If you have a building, you can sell that in that market. It's the smaller to mid-size that are available, and that's part of why we're aggressive buying right now, because you can get more deals there. And a couple that I'll point to in that space, we'll look at Northern Edge and Retro on 32nd Street. Both of these were 1960s built. there's a bit of a discount because they were built in the 60s
older,
versus the last 10 years.
2023, right.
Right. And the price per square foot on the first one, these are bigger units on Northern Edge, $200 per square foot. To go build this building today, Northern Edge, is probably double that per square foot.
Wow.
So the replacement cost to go build that brand new building, and now it would be new, but that's the opportunity, is going and buying a building at half or 60% of the replacement cost. Right now, you can get those types of prices, but when the market gets normal, the value of these buildings I expect to rise because you shouldn't be able to buy at that sort of discount to replacement cost. So that one was $173,000 per unit. Retro on 32nd Street, $133,000 a unit. Those are probably more one bedrooms than studios, so there's a bit of a discount there. But there's definitely deals to be had in the small and mid market area.
Yep.
I have friends who are a couple of friends who have just sold businesses in private equity. They have some cash, and they're talking to me about what they should do with their cash. And I see a tremendous opportunity to buy right now multifamily. If you have some cash on the side, invest in multifamily today. You want to buy low, sell high. You make your money at the purchase with real estate. So right now is when you want to buy.
Yep.
When things get hot and in real estate and everyone's like, oh, I need to buy real estate, that's actually, you've kind of missed the boat.
Right.
The
time has already passed.
The time has already passed. You need to be contrarian and buy in these times, and then when the market comes up, you look like a genius. But that's where we're at right now.
Which is contradictory to what people feel, because it feels like the market is low. Oh, let's not do anything risky. But this is actually going to pay off in the future.
It is contradictory to what you feel, because right now the sentiment is, there's a lot of problems with multifamily.
Yep.
We talked about the group that lost a building. There's going to be more of those. There's folks who have lost money in investments if they've invested in that part of the market. So they're like,
Yeah.
But it totally goes against the sentiment.
Yeah.
But talking to and listening to some of the smartest investors, that's when you make your money, is when the market's down, and that's where we're at right now.